everyone. Welcome to this edition of AFC's Future of Finance webinar series. This edition is brought to you in collaboration with Arnold and Porter, and today we're here to talk about innovation and enforcement, managing risks during upheaval in fintech regulation and uncertainty at the CFPB. But I can guarantee that this is going to go beyond just the CFPB. So for those folks that are only here to chat about the Bureau, I mean, you'll definitely get your fill, but for those that might be here for a different reason, I think there's going to be plenty of fun to be had. So I am joined by some really great people from kind of across the industry. We've got some great legal minds from our friends at Arnold Porter. We've got FTI, a great consulting firm, and then we even have a practitioner in Flex. But I won't do any justice of trying to introduce them in their full glory. So I'll just pass it along first to Janet, and then we can do just a quick round of introductions. As I know, some of you may know me, Ian Moloney. I'm the Senior Vice President, Head of Policy and Regulatory Affairs here at AFC, but very happy to have all the folks on the line. So I'll pass it over to Janet first for a quick introduction.
Well, thank you for having me. I feel honored to go first with Arnold and Porter hosting the event as well. But Janet Hale, Senior Managing Director with FTI Consulting. I am the co-leader of our consumer financial services practice. I've been in financial services for over 30 years, running the gamut from OCC bank examiner. Then I became a banker, and now I've been in consulting for about 10 years.
Awesome. Well, I'll pass it now to our sponsors and friends over at Arnold Porter. So Meredith and then Bill, feel free to give quick introductions.
Thank you so much, Ian, and it's such a pleasure to be here this afternoon, although it's still the morning on the West Coast where I'm coming from. My name is Meredith Osborn. I'm a partner in our white collar crime and government investigations practice group. And before joining Arnold and Porter, I was one of the founding members of the Consumer Financial Protection Bureau, where I was an enforcement attorney, and then became a federal prosecutor here in San Francisco. And I also have some experience at the state level where I came from most recently was the chief trial deputy of the city attorney's office in San Francisco, which takes a pretty active role in consumer protection matters, including consumer financial protection. They act as a bit of like a mini state AG out here in California. So that's me, and I'll pass the mic over to Bill.
Thanks so much, Meredith, and thanks, Ian. It is a pleasure to be here. I'm Bill Efron. I'm a partner in Arnold & Porter's Consumer Protection and Advertising Group, as well as its Antitrust and Competition Group, where I focus on government investigations, litigation, and merger reviews. Prior to joining Arnold & Porter, I served as director of the FTC's Northeast region for over 12 years, where I was responsible for the investigation and litigation of a wide range of consumer protection and antitrust matters.
Awesome. Well, it's great to have you both. And last but not least, passing it over to our friend at Flex, Harris. Feel free to give a quick introduction.
Hi, Ian. Thanks, everyone, for having me. My name is Harris Qureshi. I lead public policy and state government affairs for Flex. I've been in this role for just a few months, but I've been in the public policy arena for close to a decade now on the fintech side for a variety of companies, innovating responsibly in favor of consumers. Before that, I spent a number of years at the Consumer Financial Protection Bureau, building and leading the digital services team based in consumer engagement, and focusing on building great products like paying for college, owning a home, Ask CFPB, but also working with colleagues on the regulatory and supervision side on building compliance tools for folks in the industry. Thanks for having me.
Wonderful. Well, as you all can see, we've got just a great cross section of folks to talk about both federal and state issues, sort of what's going on the legal and regulatory side, what's going on in practice, and sort of without further ado, I think we should definitely jump in, because I know it's been a whirlwind in DC and kind of across the country this first quarter. To put it somewhat lightly, although whirlwind is never known as a light term, but just with the dramatically changing posture and scope, set of priorities of the federal government, and thinking about enforcing, of laws and regulations, especially in the fintech space. So with that all in mind, I think it's beneficial to sort of start on the legal and regulatory side with Meredith and Bill. If you could both kind of discuss how some of these changes, such as like the diminishing, or, I guess that's also putting it lightly, of CFPB, how that's impacting the regulatory and enforcement landscape at the federal level. So I'll kick it to you all and see what there is on that front.
Sure. So I guess I'll just start off, and then Bill can explain all of the things that I missed or was wrong about. Um, so I think this is a great time of uncertainty and upheaval. The fact that the CFPB is operating essentially at a skeleton staff level at the moment, with most of its employees out on some form of leave and waiting to find out what the outcome of their court case challenging the sort of mass layoffs that are planned and anticipated. That's adding to uncertainty just about existentially what will the CFPB be in the next few years. But in individual cases, companies, there's not a lot of people to pick up the phone and call and find out what's happening with my investigation, what's happening with my enforcement action. Am I going to wake up tomorrow and find out my case has been dismissed, or am I going to find out that that things are just going to be on ice for the next 4 years, which is not necessarily ideal either. Companies that want to kind of put these issues to rest and figure out what is their path forward are may have a harder time in this environment. I think there's also, concern that bad actors might take advantage of this uncertainty to undercut responsible businesses who are working hard to provide products that consumers want and that are beneficial to them. But so I think that's the answer, which is there's going to be some winners and losers here, but it's really not clear how it's going to shake out at the moment, which is not a great, this is a great lawyer answer, but maybe not a great answer for people who are looking, for a clear, and this is more like a yellow light. It's not a red light. It's not a green light.
I think it's a fair answer, just given the number of changes that have been going on. I know I've had, to check my emails, all times of day and night to see what's happening and what's going on. But Bill, feel free to jump in as well on the FTC side, or on the Bureau side, or what's happening at the federal level.
Sure. So, let me start out with just explaining just the role that the FTC plays in the consumer financial space. And it does play a significant one. That said, as many of you know, there is a jurisdictional limitation to that, because the FTC does not have authority over banks, savings and loan institutions, and federal credit unions. So in a world in which the CFPB is trimmed down, or there's less enforcement coming out of that agency, there are other enforcers and regulators that would have to fill gaps with respect to those entities. But as a general matter, the agency does have jurisdiction over wide sectors of the economy to enforce Section 5 of the FTC Act, which prohibits unfair or deceptive business practices. And its authority does cover many types of consumer financial service providers, including, of course, fintech companies. So with respect to fintech companies, as new products and services emerge in the non-bank financial marketplace and the gig economy, the FTC has been bringing actions emphasizing that companies using new technologies still have to follow the same basic laws as traditional market participants. And I think that's a really important point for fintech companies to remember about the FTC and how it approaches enforcement, which is, even as companies innovate in the products they offer and how they offer them, established consumer protection principles apply. So, in the consumer finance space, there's specific areas the FTC's focused on. Just to name a few, they've gone after lenders that promise false loan terms, lead generators that sell consumer-sensitive loan application information to non-lenders, deception with motor vehicle sales transactions, unfair and abusive debt collection. They've also targeted firms that make deceptive offers to consumers in reducing or renegotiating secured debt or unsecured debt, and deception and unfairness with respect to a whole range of other financial services and products. the other thing to remember here is that the FTC also, in addition to using Section 5 of the FTC Act to stop deceptive and unfair practices, it also enforces a number of rules in the space. So these are things like the Federal Credit Reporting Act, the Equal Credit Opportunity Act, the Fair Debt Collection Practices Act, and the privacy provisions of Gramm-Leach-Bliley, just to name a few. And, and to give people a sense of the kind of enforcement that the FTC has undertaken with respect to fintech cases, one group of cases I'd refer to are cases against online cash advance apps. And some of the claims in those cases are that there was deception by the companies to consumers about the amount of cash that could be advanced, or how quickly it could be advanced, or whether there were fees disclosed or not, and whether those fees occurred on a recurring basis. So that just gives you a sense of kind of, one type of case there. And those not only brought claims under the FTC Act, but also rule violations, which I'll talk about in a minute. In terms of what to expect from the agency in terms of enforcement, and I recognize that obviously there is a lot of change going on, but I would still say that companies should expect robust consumer protection enforcement out of the FTC. There is a new chairman of the Federal Trade Commission. In December, President Trump selected Andrew Ferguson to be the new chair, replacing Lena Khan. And he was one of the 2 Republican commissioners at the agency, along with Melissa Holyoke. And now he is the leader of the agency. And, I just want to read one quote, which I think sums up the enforcement approach that you'll see at the agency. He wrote a couple months ago, he said, "The commission under President Trump will focus primarily on our traditional role as a cop on the beat. We will vigorously and faithfully enforce the laws that Congress has passed rather than writing them." So, what does that mean? I think you're going to see vigorous case-by-case enforcement, but much less rulemaking and policy statements. I think the enforcement will be more traditional, and I think you'll see less expansive interpretations of the FTC's authority. But in furtherance of that approach, I think there's a lot of consumer protection enforcement that's occurred on a bipartisan basis, which will continue. One thing I would mention is fraud. He's made clear that protecting Americans from fraud is one of his top priorities. Commissioner Holyoke has echoed those sentiments, and that really covers a lot of ground. From my perspective, that bleeds into what I'd refer to core deceptive or unfair practices. And so some of the things I just talked about describing those fintech cases, like deceiving consumers about the nature of a cash advance or hidden fees, or whether they're on a recurring basis or not, those are the kind of things I think you'd continue to see get the attention of the FTC. And just, in terms of something to watch for fintech companies, I would name subscriptions. We saw that a lot in the online cash advance cases, where companies basically, and I'm talking about anything that's billed on a recurring basis, any charge, any monthly subscription or auto renewal program. That's been a real area of focus for the FTC for a long time on the consumer protection side. And it's a business model that both fintech companies and companies across industries have really used now. It's becoming increasingly popular just as people buy more and more things online. The FTC has enforced that in the past through a statute called ROSCA, the Restore Online Shoppers Confidence Act, which has certain requirements about disclosing the material terms of the transaction before charging consumers and having a simple mechanism to cancel. And that carries with it the threat of civil penalties. If people don't know, in October, a rule was finalized in this area called the click to cancel rule, which under the previous administration, which dramatically expands the potential liability for civil penalties for companies for negative option marketing, because it makes them liable for any material misrepresentation they make in connection with the transaction. That rule is under legal challenge right now. We don't know what's going to happen, but I would say that it's an area to pay attention to, because the states are very active in this role as well. They have passed laws in their own regard. California passed one mirroring the click to cancel rule. So this is something that fintech companies need to be aware of as they incorporate subscriptions into their model. And the last thing I'll say is one area to really expect change is with respect to consumer protection rulemaking. That's something that Chair Ferguson, I read you the quote. He wants to enforce the law and not be a regulator. Under the Democratic administration, there was a flurry of rulemaking activity over the past 3 years. That was primarily due to the fact that the FTC lost its ability to get money back for consumers. It lost its primary tool to do so in a Supreme Court case called AMG. So rulemaking represented another path to get money back for defendants. But Chair Ferguson was critical of a number of the rulemaking efforts under the prior administration. Commissioner Holyoke also said the commission's best when it enforces the law and doesn't write it. And she issued some dissents in this regard too, especially when she thought the agency acted outside of its authority. So I just conclude by saying, you should look for enforcement and not regulation from the FTC.
That's great to get kind of, if I'm understanding it correctly, that, while like Meredith was saying on the regulatory side, we've got utter confusion and a lot of moving parts and whatnot. But on the enforcement side, it seems like there's actually a pretty, like well understood, or at least somewhat well understood kind of path forward of how, the new chair of FTC is going to be handling a lot of the enforcement, and that can benefit, or that can be a benefit because he was previously already there. So so it is interesting, and kind of taking that whole context, moving over to the business side. I think it's important to always be thinking about, like, well, how are the fintechs, how are the innovative banks thinking about this? And so moving over to that side, Janet and Harris, how do you see both kind of the banks and the fintechs reacting to this rapid change in the federal government? And I'll kick to Janet first for kind of the broader industry, but Harris, we'll be coming to you for that good take on what's going on the fintech side.
Well, honestly, and as you just heard from Meredith and Bill, the biggest risk, in my opinion, is that institutions will feel this is a time where they can take their foot off the pedal and slow down when it comes to compliance. And clearly that would not be a good idea. I just want everybody on this call to remember that the CFPB did hand off a playbook to the states as well.
I printed
I'm
it
going to
out,
look
Janet.
under the hood.
It's
Meredith,
right here.
is it on
Yeah.
her desk?
I know we're
guys.
going to be getting there a little bit later,
Yeah.
so thank you for opening the door on that
Yeah,
one.
so in case you want to print it off like Meredith did, the two reports, they came out in mid-January and you can look them up. But it is the compendium of CFPB guidance documents and a report on strengthening state level consumer protections. So I do believe we are going to head there. But I just want to remind everybody that, you don't want to have the first consent order of 2030, right? And what you do now is going to affect what the regulators see and what they enforce, a few years from now. Lookbacks do go back 4 years, 6 years. We're doing quite a number of lookbacks right now, looking at data from 2021 and 2022. So just be mindful of that. Sure, innovation is important. What the fintechs are doing is amazing. They're banking the unbanked. But you need to make sure the compliance is still at the table. And I just that would be the one thing that I would stress right now.
That makes a lot of sense. Oh, Harris, go ahead.
I was going to say, absolutely agree, Janet. I've had the fortune, and particularly at Flex, what our business is focused on is providing flexible rent solutions and rent payment solutions to renters. Because while there is regulatory uncertainty on the consumer side, consumers are going to continue to evolve their expectations. The market's going to continue to evolve. How money moves continues to evolve. So we need to continue to keep pace, but that certainly doesn't mean we should slow down on the compliance front. So I think it's up to companies to continue holding ourselves accountable. Flex has done a lot of great work with companies like Fair Play AI. I won't steal a lot of thunder from our chief compliance officer, who's doing a whole hour-long presentation today at the Just Economy conference, specifically on that. But that's just one example and of how we can double down on compliance internally and processes and procedures. And as Bill reminded us, there is still a cop on the beat, slightly separate jurisdiction, but there are still rules for the road for folks to be thinking about, but that doesn't mean we shouldn't continue to innovate responsibly, particularly when we can work in the favor of consumers. So I think having an eye towards that and focusing on positive outcomes. So, one of the things that Flex does is it's a relatively new space as consumer expectations have evolved, consumer lending has evolved, and payments have evolved. It's kind of merged into one where consumers aren't even thinking about how they're making a transaction. They just know it needs to be completed, it needs to be done, they need to have access to the goods and services they're expecting. And our job is to make sure that all the pieces fit together coherently in a clear and consistent way, and the consumers understand what's actually what they're getting as a net result. But there are companies like Flex who want to continue innovating for consumer good. One of the positive outcomes we've been able to deliver, I'll drop a link in the chat for folks, but we have a great study on measurable positive financial outcomes. So one of the things that we've been able to do is, by providing financial certainty, is delivering not just near-term positive outcomes for financial health benefits and reducing for 92% of customers, helping them avoid fees and penalties, reducing their need to borrow money later on in the month by helping them with the biggest household expense, which is their rent. But then even in the longer term, improving their ability to manage finances and bills, for months and months onward. So I think keeping the focus on innovating positively for consumers, positive outcomes, and holding ourselves accountable to build those processes and infrastructure early on is a great thing for companies to keep in mind.
No, I think that makes a lot of sense. And I know AFC is always focused on responsible innovation. And really the core to that is, what are you doing when no one's watching? And how are you engaging? And so, I think it's sort of in lieu of the robust federal side. I know there's been a lot of ink that's been spilled, and we have the playbook that Meredith and Janet mentioned about, what the states can be doing in the interim, And this has become, sort of a talking point for us of that the change in administration doesn't necessarily create, just an easier area. It actually can create a more difficult area, thinking about the state enforcement and the state engagement. And I know Bill gave us a really good understanding of kind of the cop on the beat that's still going to be there on the federal side. But Meredith, I'm gonna go to you first to sort of ask, what should companies be expecting from the state side, the state attorney generals, and are there particular areas or products that they're likely to face increased scrutiny in this new environment?
Yeah, absolutely. And I just, I want to build off what both Janet and Harris and Bill all said about things that the company should be worried about in this sort of new era. I think we are going to see increased scrutiny of the practices and industries that were a focus of the Biden administration by certain state AGs, right? Big blue state AGs like California, New York. There are a number of others, and those state AGs are likely to look at and particularly scrutinize the types of practices on products that were of concern to the Biden administration. I'm thinking particularly of junk fees, what they call junk fees, subscription services with recurring fees or payments, as Bill said. And Bill and I did an advisory, which I'll just drop into the chat as well, about California's new requirements. They had a ROSCA, mini state ROSCA law already, but they beefed it up more recently, and those new requirements went into effect in January 2025. So, this is important that folks are aware of, and it's a big burden, I will say, to be on top of the different state requirements in 50 different states, which is, I think, to Ian's point, why it can be a blessing and a curse to have a state, a federal regulator who sort of goes dark. Many CFPB and other federal government enforcement attorneys are looking for and finding jobs at the state level, and they're bringing not only the playbook that I mentioned, but they're bringing their expertise and experience on these topics with them to those state offices. And although historically state AGs have been under-resourced compared to the federal government, they're likely to rely heavily on private plaintiffs' attorneys to investigate and bring cases in the first instance and sort of build off the work that's done by those lawyers and law firms. This roadmap on guidance on cooperative federalism gives that roadmap, and talks specifically about using those sort of private relators or plaintiffs' lawyers to bring cases. And I'll say, just because one of the things that's gotten back up online very quickly is the CFPB's complaint acceptance function. So just because they may not be investigating those complaints doesn't mean they're not receiving them and they're storing them. Other states have access to them, and that is always a focus of any enforcement authority is what are consumers complaining about? And if they aren't getting any feedback from the CFPB, they're going to go to their state AGs and start complaining to them. And so, it's really important to be on top of that and not let, a small problem can quickly spiral when you see folks, start complaining about something and your complaints just start soaring in a way that you may not have expected, and that's your next potential lawsuit. So I'll kind of stop there. I feel like maybe I've said enough scary things for one.
I would just add one thing, Mary.
Yeah, go ahead, Harris.
You're absolutely right. And I mean, like, folks likely are, if the issue is troublesome enough, they likely are already complaining to their AGs, right? And I think one area that AGs in particular might borrow from the CFPB's playbook is creating some transparency around that complaint process. Right now, it sometimes goes into a vacuum. So that might be a space where AGs offices or state regulators find an opportunity to innovate, is creating their own more or less public database or some limited subset of data around complaints that they're receiving. And there's pros and cons to that. One obviously is some of that might make some companies look bad, but it will certainly promote more positive customer service outcomes. But it may also provide more clarity as to the level of volume that some of these AGs are facing in certain states. But that on the AG side, I certainly expect that'll be one cue that they'll be taking.
Yeah, and I don't want to suggest that just because the CFPB is on the bench at the moment, this is my only sports metaphor that I can reliably use, but that there aren't other federal enforcement activities that are not just at the FTC, but obviously the DOJ's Consumer Protection Branch has sort of signaled they are full steam ahead. Now, what that means and who the leadership is still, I think, a little bit uncertain. So it again, it's like, it's trying to judge when is the best time to think about approaching DOJ if you have an ongoing investigation or enforcement action, but also thinking about, this is a multi-threat environment, and it's not going to be just that you're just going to have to worry about the states now. You're still going to have to think about protecting yourself against fraud, protecting yourself against having a spike in complaints, things like that.
Yeah, and I think that it really, you've opened the door really well to that discussion around enforcement and thinking about the regulatory, the free movement of people is never has, I don't think it's ever been better shown in this or at any time as in this time of from the regulatory side. I've already seen people that I know from federal workforce at the state level, and so thinking about some of that natural kind of alignment that can occur, and I know, Meredith, you had hedged a little bit or mentioned around California and New York, but just Bill, kind of connecting to your FTC experience, how do you see sort of alignment with different state AGs with regards to their activities?
Sure. So it's a great question. So just first of all, as a general matter, I mean, the FTC has a long and rich history of collaborating and working with the states. So they frequently collaborate on investigations with state AG's offices, conducting joint investigations on both the consumer protection and the antitrust side, and bringing cases as co-plaintiffs. When I was at the agency, my office worked frequently with state AG's offices on law enforcement matters, and that's true of offices and divisions throughout the agency. And one thing I would add, though, is that I referred to this AMG decision before, where the FTC lost its ability to get money back in a lot of situations for consumers. So not that the FTC hasn't always partnered with the states, but it's also one additional reason where you see that partnership, because there may be situations where the FTC cannot recover money back for consumers for a particular unfair deceptive practice, but the states can, because they all have their UDAP authority and various civil penalty authorities with that, or the ability to get disgorgement. So you can see the FTC and the states partner on that basis. But what I would say is that, look, there can always be instances of disagreement on a particular matter or initiative, but I think collaboration will still continue on many cases and initiatives, particularly where there's joint interest in going after fraud. And that can be really, I mean, over the years, that's been really a broad range of unfair and deceptive practices, including a number of actions in the consumer financial services space. I think of deceptive, unfair, and abusive debt collection as one, where there's always been, cases brought jointly with states, but that's one of many. And, when you talk about aligning, I mean, that really can come in several different forms, right? There can be areas where the FTC and the states are active in the same area, even if it's not on the same matter. So we just talked about subscriptions where, you have the FTC pursuing its enforcement actions and, pass this click to cancel rule. And then you have the states also active in the same area. But then in addition to these joint law enforcement actions on particular cases, there's also something called sweeps. And that's where the FTC and the state AGs get together and they bring a number of law enforcement actions, separate ones focused on law violations in a particular industry or sector. And that, the feds and the states feel, that has a multiplier effect and shines a light on particular conduct. So, and those have covered, again, a range of unfair and deceptive practices. So I think, you'll continue to see those partnerships on a number of areas, but I think Meredith makes a great point, which is that there are going to be differences. There may be things that were pursued under the FTC under former Chair Khan that won't be pursued now. So you may see the states, let's say there were more aggressive interpretations of law or novel theories that you might not see as much at the FTC now, but you may see some of these states bring those types of cases in certain areas. So I think that's one thing to look out for.
I hear you on that, and especially when you think about the multiple, where an agency or an AG at the state level might be involved in the same area. I mean, you could see kind of multiple cases springing up in the same area. So I know we're in springtime, but it feels like there's a cold chill kind of coming across. And so with that cold chill in mind, Janet, like, how do you advise, these companies in this sort of, engagement with their AGs and the role of the state enforcement, and what should the fintech companies be focused on at the state level right now?
Sure. So I would just say two things, because as a consultant, I always want to make sure that my client walks away with an understanding of what are the next steps they need to do, right? Because we can talk about changes to state law, we can talk about all of these cases, but if they just understand what the implications are for that particular institution, it's important. And in my opinion, it really comes down to two things. If you want to think about a framework to put into place at your institution, regulatory change management or change management in general, right? Because if these particular new state regulations come out, for example, if your institution doesn't have a good way to identify them, understand what products and services they affect with a mapping process, making sure that somebody has a role to implement that change and then test it down the road. It doesn't matter how much knowledge you have. If you're not implementing that change into your institution, you're going to have an impact that's not going to be favorable down the road. And I would say, honestly, the same thing with complaints. We might have a state, I'm hearing Pennsylvania has an amazing complaint ability to they just got some complaints. I don't know if it's because their website's great or they just advertise it more, but that's great. But if you don't take those complaints and analyze them yourself, whether it's from any agency, it doesn't matter which agency it is, you need to bring that in-house. You need to compare that to what you're getting directly. You need to, a sponsor bank needs to understand what their fintech partners are receiving from a complaints process. So when we go into our clients and we help them set up, whether it's a change management program or assisting with their complaint program, a lot of times we see them siloed, they're not managed, they're not reported. So I would say this is a great time to go back, understand that there's a lot of change right now, but you also need to figure out how to implement and understand what those changes are within your institution and set up those frameworks if they aren't there currently, because it's only going to get worse when we have this patchwork of laws and rules and case studies that are out there.
I think that makes a lot of sense from an operational standpoint. You want to know what's going on with even outside of your walls when it comes to complaints, because, I know it's a conversation we've had a lot. There's not that same sort of materiality threshold around consumer complaints, and the usage of consumer complaints can be really at the agency's discretion. So you want to get a handle on that. So that makes a lot of sense. And Harris,
It's a
I know,
gold mine.
yeah.
It really is.
Okay.
I mean, you can learn so much from it. So not just from a regulatory perspective. I mean, you can learn whether like the consumers like your products, like what do they like about them, what they don't like about them. I mean, it's really a business advantage in order to be able to take those consumer complaints and understand, what the consumer wants.
Yeah, that's a great point. And I selfishly always think about the regulatory side, but and I know, my fellow government relations person with Harris, you probably are thinking about that too. And so, kind of thinking about that from the GR side, how do you think fintech companies should be adapting to the influence of state regulators, and sort of what steps can they take to better align with the state level enforcement?
Yeah, absolutely. First, I'll just say to Janet's point, 100%. And, not just taking that feedback for compliance and for other inputs, but take it to the product teams. I think, one of the things that I have enjoyed working with product teams specifically is oftentimes they want as much customer feedback as possible, whether that's through, direct user experience testing, whether that's, diary exercises or something. But all this is fantastic feedback. So good opportunities to work directly with the product teams as well. I'd say when it comes to the state regulators, Ian, to answer your question, one of the things that's important is once you've started building a robust program to be responsive and internally to the feedback, a great compliance program is not shy away from working proactively with regulators, even the state ones. I think I've been fortunate, in each of my roles, have looked for those opportunities to tell the story of what the brand or what the company is doing, particularly when you're innovating in favor of consumers. And a lot of times when it's a space that is relatively nascent or not as well understood by regulators or legislators, takes a lot of explaining as to what the product is, what is the value proposition, how are consumers actually perceiving it, how are they using it. So being able to share that perspective with regulators early on before they take a complaint that's actually about something else and misunderstand it, having those opportunities to build those relationships early on, I think is important. I think obviously one of the challenges now is it's not just relationships with a few federal regulators, it's how do we prioritize and think about which states we want to engage with first and foremost. So I think that's going to look a little bit different for each company based on where you have a larger customer base, where you anticipate legislation or regulatory interpretations that are going to impact certain aspects of your business. So each company is going to have to kind of figure out that recipe for themselves. But I think first and foremost, you can't go wrong if you focus on where your customers are and solving for their needs first. So one of the things that we've done at Flex is thinking first and foremost where our customers are, there's the biggest need, or where we can want to see the most growth. How do we get ahead of some of that by engaging with regulators or legislators, for that matter, early on to help them better understand what we're trying to achieve, how we're doing that, and particularly when you can take data to help demonstrate that positive impact or those positive outcomes is great.
Yeah, and it's interesting because I mean, thus far in the conversation, we've had kind of the balance of the discussion on what's going on at federal, what's going on at state, but really it's been all focused, I think, on this idea of, regardless of kind of what's happening outside, that's always important to take into account. But there's this need to really make sure your house is in order and being proactive with whomever is engaging with you, and thinking about where your product, like Harris, you were saying, where your product or service is really focused. And so, and, you know, doing your due diligence and making sure that those areas are really a focus as well. Recognizing, you know, the costs do become more significant with you know, 54 jurisdictions potentially that you have to do, recognizing the lack of geographic constraints for fintech. But Harris, sticking with you kind of on that, you know, innovation, compliance focus, I know you had talked about that, you know, again, kind of keeping your house in order, but what do you think, you know, fintech companies should be thinking of with that policy environment, and recognizing sort of the need for clear and consistent rules of the road? What do you think they should be, you know, working on, or how do you think they should be engaging with that sort of desire to have those clear and consistent rules?
Yeah, that's a really good question. I think the makeup of different companies is going to, you know, lay out how they answer that. But I think first and foremost, once you can focus on how you want your business to evolve through this period of regulatory uncertainty and how you want your business to evolve uh, through any type of market changes you're going to anticipate. So I think building those programs are effective not just for compliance reasons, not just for tackling any regulatory issues or questions, but I think if it's particularly when they're foundational to how your teams are going to function, those are the ways to best serve the business. I think where there are particular gaps in the market or in the regulatory space that we're seeing from the CFPB, if it's a particular issue, you know, we certainly understand that there's the FTC that is still the cop on the beat for that particular landscape. But where there's issues where the CFPB would be the one to kind of answer that question, or the Office of Innovation or the markets team would be our go-to people, find the state regulators that are thinking about those issues carefully. So whether it's offices of innovation at DFPI or New York DFS, you know, there are other folks that are thinking about how to tackle some of the same issues. So think of them as thought partners, I think, particularly once you have some subset of data to take to a discussion. And I think there'll at least be some guideposts along the way for how to get to the next mile marker.
Yeah, that's great. And I know we've had a lot of really good engagement over the years with both state and federal offices of innovation. And, you know, Janet, I know you're working kind of, you know, boots on the ground with your clients, thinking about, you know, changing regulatory requirements and, you know, making sure that they don't stifle innovation. So can you share any best practices or frameworks that you think have really worked to try and, you know, ensure that any sort of regulatory requirements are not stifling innovation for your clients?
Sure. And of course, you know, my background is in compliance. So I would definitely say make sure that compliance is at the table during the development stage of whatever product or service is being developed. Don't bring them in last minute. If you bring somebody in last minute, it's so much more difficult to maybe course correct if necessary. You don't want the compliance team to be, you know, the group of no, right? But they can absolutely sit at the table with you, provide some guidelines, some rails so that you understand what you can and cannot do. And then you can innovate in between those rails. I mean, there isn't any reason why you can't move forward with your product when you have that ability to have compliance at the table to adjust if necessary. And so I think that would really be my biggest recommendation. I know when I was at a bank, and of course it was a bank and it was a large bank and moved much more slowly than any fintech. But at the same time, we were always at the table. And if there was something that we saw and we could let them know early on, it just makes for a better product in the end. And also, you know, it could be worse down the road if you had to unwind a product, or even worse, that product was out there and then you find out it's non-compliant, not because you're internally figured it out, but because the regulator is telling you so.
That's great. And I think, you know, seeing or sort of considering that compliance first focus, you know, it makes me think about what are the risks associated, you know, and what do you know, what are all sort of, whether the OCC is looking at reputation risk or not, like there's probably a need to think about, you know, reputation risk even internally. And so Meredith, kind of on that risk discussion, you know, what are you seeing as far as, you know, a way to that companies can sort of de-risk innovation, you know, in their practices?
Yeah, But that's a great question, Ian, but I've noticed a couple questions in the chat that I also wanted to address just
Oh,
because
sure.
they're kind of on this point about the CFPB's enforcement actions and what's likely to happen in the coming months. One question was about the Townstone refund, which just was announced this week. This is a refund of about $100,000 penalty that was assessed against there was a mortgage lender that was doing a lot of advertising that seemed to sort of actively encourage discrimination in lending, and then actually had significantly less lending in minority neighborhoods than in non-minority neighborhoods. So that was actually an enforcement action that was brought under the CFPB's Director Kraninger. That was Trump's first appointed director during his first administration. So, in some ways, this may have been a bit surprising that he reached back, not only to reverse enforcement action that was issued under his previously chosen director, but also one that was relatively small and so long ago. But I will say it did kind of hit on a few of this administration's main priorities, things like freedom of speech, things like cutting back on sort of novel theories or methods of attacking discrimination. And so the fact that it was relatively small probably made it easier to do. I don't necessarily think we can anticipate reversals of some of the larger penalties that have been assessed against companies over the last few years. For one thing, I think that would negatively impact DOJ's dashboard, and so that might not be a good look for this administration. But I do think there may be opportunities if you think that an enforcement action was sort of, might be one that might get this administration's attention. It's certainly not impossible that we will see more of these. The question is how many resources, are they organized enough? Are they doing, is this opportunistic, or is this a more, methodical review of past enforcement actions? To me, this looks opportunistic. It doesn't look methodical, and it doesn't look like it's going to be, they're going to be looking at every enforcement action that was issued over the last 4 years. So that's Townstone, that I think we could see more, but I don't think we're going to see a lot more or in any kind of organized way, at least not in the immediate near term. The second question was about the CFPB's small dollar lending rule, which would go into effect next week. This has not been one that I have seen sort of, and please, Ian and Harris, if you have heard more on the legislative side, I haven't heard this one sort of brought up as a target for the Congressional Review Act or for other efforts to overturn it. I will say, with all of the rulemaking apparatus of the CFPB also on ice, it's a little hard to undo rules without staff working to do that. So, there's a little bit of a chicken and the egg problem. You can't lay everybody off and also get rid of the rules that you don't like. You have to actually have some people in place to do that work. So we'll sort of see what the priority is, whether it's getting rid of the CFPB or getting rid of the rules, because the CFPB could be gone, but the rules will still be on the books. Of course, whether or not that's enforced, I think that we can much more easily say that rule probably is not, without enforcement by the CFPB, probably not going to be a priority for enforcement by other agencies either. Doesn't mean it won't be on the books and couldn't become back to bite you in a later administration. But I don't see that as a enforcement priority, certainly. But also not a priority to overturn either. I don't know if folks have other reactions to that.
Yeah, I can just quickly, note that, I think when it comes to the rulemaking, especially around the small dollar rulemaking, recognizing that it really doesn't have the same play within the Congressional Review Act look back that some of the other rulemakings do. But also, my sense is that the amount of concern and consternation that the current administration and the Republicans kind of gave to the Chopra directorship around regulating through blog posts and informal means pushes me in the direction of thinking that they're not going to necessarily pursue that activity unless there's no other option when it comes to providing guidance or doing anything from a regulatory standpoint. And Meredith, to your point, there's an inability to do so if there's not people manning the desks or being at the agency. So it becomes very difficult. But Harris, I don't know if you had any thoughts on that as well.
Yeah, I was just going to add that it certainly was not something that was expected and opportunistic. And I think to the extent that they're going to continue to rely on, appointees from OB or, detailees that they're bringing in from OB to do some of these procedural rulemaking steps or court filings, I would expect some more missteps or improprieties along the way because their expertise isn't in the rulemaking space. So I would expect some more irregularities in the process.
No, that's great. And Bill, I think, kind of keying in on that Townstone discussion, and thinking about sort of the enforcement, with the new administration. I know you had talked a lot about that, but how do you see sort of that balancing of consumer protections and enforcement with the innovation front, thinking about some of those changes that are going on at CFPB?
Sure, it's a great question. Well, look, I would say first of all, as a general matter, promoting innovation really is a priority in the new administration. When President Trump selected Andrew Ferguson to be the new chair, he said he would be the most pro-innovation chair in American history. And one particular area that I think about one particular area of enforcement at the FTC that I think about when you bring up this topic that's very relevant is with respect to artificial intelligence. So this is an area that Chair Ferguson and Commissioner Holyoke have been very outspoken about the need to foster innovation in the AI space. And Ferguson has also repeatedly argued against the FTC acting as an AI regulator and specifically warned about stretching consumer protection authority to do so. There's one quote that he said, which I think sums up the enforcement approach and dovetails with something I said earlier. But he said, for now, we should limit ourselves to enforcing existing laws against illegal conduct involving AI when it involves AI no differently than when it does not. And, I think that's a real way to frame how you'll see enforcement here. And look, I think it does come down to a case-by-case basis, but there's obviously this prioritization of innovation. At the same time, when you look at the voting record, Ferguson and Holyoke did support a number of the AI enforcement related cases that were brought under the prior administration. And those were cases where, companies were falsely touting the capabilities of their AI products or using AI tools to deceive consumers. And in one of those cases, Chair Ferguson issued a concurring statement. It was in a matter called Do Not Pay. It was about the claims about the world's first robot lawyer. And this was a case that he supported. And I think it's illustrative of the enforcement approach you'll see the Bureau of Consumer Protection to take in the new administration. He said that he was happy to vote for it. And it was a great example of the commission enforcing Section 5 of the FTC Act against businesses that deceive consumers about the capabilities of their generative AI services. But in concurring, and he warned businesses, he said, look, if businesses exploit the media hype and with the new technology to cheat people out of money, they should expect a knock at the door at from the commission. Except he said, importantly, in supporting the case, he made clear that the commission was holding generative AI companies to the same standards for honest business conduct that apply to every industry. And that was opposed to regulation of AI for the sake of AI. So, I think that goes back to a principle I mentioned before with fintech companies that, look, even as they innovate, it's that these basic consumer protection principles apply. And I think that that's the way the FTC balances those things.
No, that's great. And I hear you on the point about innovation being kind of this administration is very, very very pro innovation. And I think to like the nominations of Jonathan McKernan, the positions that acting FDIC chair Travis Hill has taken, Jonathan Gould being nominated to OCC comptroller, these are, and also, Chair Ferguson over at FTC. These are folks that really have been focused on innovation. So with our last question of the day, I think, selfishly, I have to ask all the great folks on this panel, what role does public policy advocacy play in shaping the future of fintech regulation in this new administration? So Harris, since you're the practitioner of all practitioners, although I know everybody here really has that foot in the game, I'll start with you, sir.
Yeah, that's a fantastic question and a great way to lead this off. But I'd say innovating in favor of consumers is going to continue to be the best way for fintech companies, or any company for that matter, to move forward. Because while there's uncertainty as to which regulators are on which base or covering which area, particularly from the CFPB, I think one thing that's clear is bad actors in the space are going to continue to take advantage of consumers. And one way for good actors to continue to distinguish themselves is deliver incredibly good value for consumers, positive outcomes for consumers, and work proactively with the regulators that they do have.
Yeah. Janet, feel free to jump in too.
Yeah, I mean, public policy advocacy is so important. I think the AFC does a great job with that. And I think also, honestly, we need to remind the regulators that a lot of these products are out there because of consumer demand. Their needs were not being met. And therefore, it led to the innovation. It led to all of these amazing products in which individuals can now get a loan so that they can get their car fixed, so that they can go to their job. And so I think that is something that we really need to remind the regulators about. They're not trying to take advantage of the consumers. All of the clients that I've met really have the consumer first. So I think that's important from a public policy advocacy perspective.
Awesome. Bill, anything to add?
No, I think Harris and Janet said it well.
Awesome. And Meredith, I'll give you the last word as our deepest of deep friends at Arnold and Porter.
Well, I think public advocacy is fantastic, and I will say I was with AFC at a meeting with the DFPI, the Department of Financial Protection and Innovation here in California, about a month ago, and there is clearly a very good relationship, healthy relationship between industry and the DFPI in California, at least in some areas, and they're very interested in like learning more and have taken steps to kind of bring new products and services, into a compliance friendly environment where they are, at least in earned wage access, like rolling out a licensing and regime, which is, I think, very helpful for industry here in California. Other states, though, are proceeding through enforcement. And so I'll end with the public advocacy is no replacement for having a strong legal foundation for whatever products and services you're rolling out. And that has to be based on an existing law, regardless of your hopes for what advocacy may bring for the future.
I think that's a great way to finish this off, that really, responsible innovation starts with responsible innovators, and there is no substitute to that. And, I know we work hard at AFC to help out on the policy side and, good networking events, but it really starts internally. And so with that, I want to thank our wonderful panel for joining me for this episode of the Future of Finance webinar series. And, really want to thank, again, our collaboration with Arnold and Porter on this. And I thank you, the audience, for sticking around and having a great time with us. All right. Have a good rest of your day.